Hello and a warm welcome to Personal Finance. I'm Gugulethu Cele. To fix or not to fix? Now that seems to be the question that many South African consumers find themselves fighting with, especially following the MPC decision we saw recently where interest rates were kept flat in South Africa. But what are the terms and conditions of fixing your interest rate on your kind of credit and more importantly on your home loan? Well, we'll find out from our two guests today. We're first joined by Izak Oddendaal. He's an investment strategist at Old Mutual Wealth, joining us from our Cape Town studios, and Tommy Nell, head of credit at FNB Homeloans. Good to have you with us both, gentlemen. Maybe Izak, let's start off with you in our Cape Town studio. Maybe to give us some more perspective as to how something like the MPC announcement has ripple effects of substantial magnitude on the South African consumer and their accessibility to credit and their wealth creation plan.
I think the main thing is that the Reserve Bank, through their Monetary Policy Committee, have signalled an intention that they want to increase interest rates, even though they kept interest rates unchanged at the latest meeting. How this affects consumers, it will obviously depend on the magnitude of those increases. Now, the last interest rate increase was only 25 basis points, and indeed in this entire cycle we've only seen 75 basis points increases. So it hasn't been a very big increase from the Reserve Bank yet, and I don't expect a big increase in the next year or so. But obviously if you have a lot of debt, at the margin, it makes a difference. I think the Reserve Bank is also conscious of the fact that consumers are struggling, and that's one of the reasons why this interest rate cycle will probably be different from past cycles where you've seen quite a big swing in interest rates.
Tommy, to come to you, if you can put on your economist hat or, a consumer activist hat, there are ripple effects because there's a correlation here between several issues. There's inflation, which eats away at the money which you're trying to help create, interest rates, which also have a relationship with inflationary pressures, and like we said at the beginning of the show, has an impact on consumers. Given what Izak has said about this different interest rate rising cycle, how should consumers be reading this?
So, Gugu, I think the important part is that as a bank, we think it's better for consumers to look at fixing the interest rate more from a risk management perspective than necessarily trying to time the interest rate cycle. Izak might be quite right. So maybe this time the full extent of the interest hiking cycle is 2%, 2.5%. I mean, it's anyone's guess. Previous cycles has been 4 or 5%, and often I think the question comes down to if a consumer can afford a fixed rate that is offered to them, let's say at their current home loan rate of interest plus 1%, and they could have that option, then it's maybe not a bad idea to take it if the eventuality of rates going up by 2 or 3% might mean that they might lose their property. So we actually caution people against trying to time the rate hiking cycle. And to more look at your personal financial situation, understand your exposure to interest rates. All banks have calculators on their websites. Go and put your loan amount in there, calculate your sensitivity to interest rate increases, and if you could protect yourself against interest rate increases, it's not always a bad idea. One shouldn't just look at trying to beat the cycle. And then for that same extent, if you fix your rate now, there's no point in looking backwards and saying, but what if I did this, what if I did that? If you make that risk management decision and say, listen, I don't want to expose my household to this risk of potentially losing my property, then you've made the best possible decision with the facts at your disposal. So I think once you make that fact and you protect, make that decision and protect yourself from that risk, then don't play this game of looking to beat yourself up if you get the call wrong and then rates go up or don't go up, because I don't think that's the point.
Something important that you mentioned was obviously affordability, and I take it that's what it needs to go back down to, as you've alluded to. So quite in-depth research that needs to be done, not only with your home loan, but I take it across the board when you look at how this might impact other credit facilities you have. Tommy?
Absolutely. So I think a practical tip for consumers would be take your bank statement and then go and highlight all of the debt that you have where there's a variable rate of interest. So on the loans that are fixed in nature, obviously the rate increases or decreases doesn't affect your budget. But I would say, go and highlight, if your car loan is on a variable interest rate and your home loan, go and highlight those and then log onto your bank's website. Every bank has the facility, and go and stress test your installment. It's as simple as putting in 3 variables, your loan amount, your term and your interest rate. look at what the repayment would be under the current interest rate, and then say, what if it increases by 1%, 2%, 3%? And then if you transfer that into your budget, you can very easily see at what percentage of rate hikes does your family budget then no longer make sense. And at that point, if your budget, let's say, breaks at a 3% rate hike, and you think that 3% is going to materialize, it might be a better idea to then fix at 1% above your current rate. So there's never any silver bullet that one can give consumers advice that will work for each and every person. It really comes down to your own household position and your own exposure to interest rates. And if you can stomach 5, 6, 7% of interest rate increases, then
sure.
Kind of what's the point? But you do need to understand at what point would you be putting your home potentially at risk.
Izak, to come back to you for a moment and maybe get your comments on the back of Tommy's sentiments that have been shared here, but more importantly as well, like you said, this seems like it's a different interest rate rising cycle, one that's slightly different from what we've seen previously. If you can give us more details with regard to those sentiments.
Yeah, I think basically the thing is the Reserve Bank is trying to keep inflation under control. And inflation has behaved differently in this cycle compared to previous cycles. If you think back to the lead up to 2008 and again, or previously in the lead up to about 2002, when we had a big rand depreciation, that was followed by a big inflation move and a big interest rate move. This time around, we've had the big rand depreciation, but we have not seen any change in inflation. Inflation is, at the moment is 4.5%, and it's barely moved above 6% in the space of the last 5 years. One of the reasons for that is because the economy is weak, and it's because consumers are battling with high debt levels as it is, and they're not using the low interest rate environment to borrow more. In fact, they're generally trying to pay off debt. So this is not the kind of environment also where the Reserve Bank is trying to kill off a credit boom or rampant demand on the consumer side by changing interest rates. That's what we saw in the previous cycle. So in this current cycle, the Reserve Bank's mindset is a lot more about protecting their own credibility. They've said that this is a rising interest rate cycle, so they need to follow through with that to an extent. And also they're very concerned about global interest rate movements and what the impact of that on the rand and local inflation. So given that you have a weak economy, you've got inflationary pressures, but not as much as you would have seen historically. You put those two things together, and you have to say that you're not going to see big swings in interest rates because the Reserve Bank finds itself between a rock and a hard place on the inflation side and the economy side, and sort of the middle path between those positions is to keep rates relatively unchanged but with an upward bias.
Izak, to stay with you for a moment, you are an investment strategist. If we touch on wealth creation, I take it if there aren't too many risks towards the rising interest rate cycle, then there aren't too many opportunities then on possible wealth creation and savings, which might be linked to interest rates. Is this so?
It really depends on each individual, and it also depends on the time horizon. So in the very short term, rising interest rates means you're going to get more money if you park it in a bank deposit or in a money market fund. If you want to create wealth over the longer term, you need to be looking more at assets that are really not that correlated to the interest rate cycle. And there you're talking about equities and property and the like. So it really depends if it's a long-term investment or a short-term investment, or if your mindset is to try and grow capital versus trying to protect capital. I think any individual needs to look at their own circumstances, maybe sit with a financial advisor, and the issue is always to diversify properly. And I think the issue of risk management that was raised earlier is also an important mindset to try and understand what are my risks in any given scenario.
Time now for that all-important segment where we wrap the conversation up. And Tommy, to come to you, the key considerations that consumers need to be aware of before deciding to fix or not to fix the interest rate on their home loan.
So Gugu, I think if you look at the term structure of interest rates, a very fancy way of just describing that, longer term interest rates are generally higher than shorter term interest rates. My caution would be to never just look at that when making your call as to whether to fix or not. fixing will probably cost you a little bit extra on the long term. But if it's the difference between losing your property or not, it's sometimes good to see it more of an insurance kind of a risk management angle, and not trying to necessarily save money. It's really just to protect yourself against those events that one doesn't see coming. A rand shock, a oil shock, emerging market crisis of sort, and these things aren't. We can't predict them. We've got very many well-informed analysts around the world, and these things just cannot be predicted. So I don't think it's worth taking that gamble. If you know that you can only stomach a 1% rate hike before your budget turns negative, and you get the option to fix at that 1% more, I think it's more often than not, it's a really good decision for people to take.
Tommy, just before we go to Izak to get his closing points, the kind of terms that we're looking at here, how long can one fix the interest rate for?
Yeah, so that's not consistent between all the banks. At FNB, you can fix up to 5 years. So that's a decent amount of protection that customers can give themselves. And I would actually encourage all customers to go and find out what rates potentially they could qualify for. The unfortunate thing is that one shouldn't wait too late. We about 12 months ago at FNB, we phoned a lot of customers and offered them a fixed rate at the same rate that they were paying variable at that moment, and we had no takers. And I promise you, if customers took us up on that one, they would have been laughing all the way to the bank, as they say at this point.
Tables are turned now. They're calling you, huh?
Exactly.
Izak, if we come to you, just to get your closing points from tonight's conversation about understanding the impacts of the MPC, repo rates, interest rate, and the relationship and correlation it has with consumers' finances.
I think the important point is every consumer needs to understand his own financial position, and understand what the impact of an interest rate increase or 2 or 3 would be on their debt situation, on their repayment situation. Find out what the bank can offer you before you decide to fix. And remember that if you're fixing an interest rate, you're fixing it at for an entire period. Whereas if you leave it unfixed, it moves up and down with the cycle. So you need to also look at the average interest rate that you're going to pay across that cycle. Maybe that is higher or lower compared to what level you'd be fixing it at. So, but that will depend on the individual consumer, and that's something you'll need to find out from your bank as to what they can offer you. But it's not, it's not free to fix your interest rate. So it's something you need to bear in mind.
Well, there we have it from our 2 experts giving us the answers to our questions regarding fixing or not fixing your interest rates. A big thank you to both my guests this evening, Izak Oddendaal. He is an investment strategist at Old Mutual Wealth, joining us from our Cape Town studios. And here in Johannesburg is Tommy Nell, Head of Credit at FNB Homeloans. Join us again on Personal Finance, and you can keep in touch with us on Twitter using our account at CNBC Africa, #Finance410. Until next time, have a wonderful evening.